What's going on, everybody, and welcome back to yet another video. In today's video, I want to show you guys how you can fast track your way to making $10,000 a month trading. And real quick, if you guys aren't familiar with who I am, my name is Brandon. I go by Brandon Trades, and I started learning about the stock market in 2017 and have been trading full time since 2019. I've helped thousands of traders find profitability in the market, and I teach for free every day here on my YouTube. So if you guys do find value in this video, it would mean the world to me if you guys hit that like button, and also make sure you guys are subscribed. So before we hop into this, there is one thing that I need you guys to understand. Trading is going to come down to trial and error. There's no single course or mentor that is going to make you profitable. Now, there is some debate if you should learn from one single person or many different people. I personally say go out there and learn from multiple different traders because everyone trades differently. So as you're learning from multiple different traders, you're going to pick up on bits and pieces from each of them. And through trial and error, you're going to find what makes sense to you and what works for you. So maybe you take a piece of my strategy, a piece from somebody else, and then another piece from somebody else, and you piece them all together, and that's what makes your strategy. You never want to trade exactly like somebody else, especially if it doesn't make sense to you. So again, learn from multiple different people, put it through trial and error, and develop your own strategy out of it. But hopping into my strategy, my trading strategy, I keep it very simple. So KISS, keep it simple, stupid. I see a lot of traders who overcomplicate their strategy. So really what my strategy comes down to is trading key levels, and these key levels stem from supply and demand, Fibonacci, support and resistance, and then a few select intraday setups. Now, when I am trading these key levels, they're mainly based off of the higher time frames. So typically what I'll do is I'll start on a weekly time frame, break it down to a daily to a 4 hour, a 4 hour to a 2 hour, and then a 2 hour to a 1 hour. And the reason why these higher time frame setups are important is because those are going to be higher probability, and it's going to lead to a larger move in the market. So remember, the higher the time frame, the more important the setup is. And honestly, I would say probably like 95% of my trades just stem from supply and demand and Fibonacci. If you don't know how to draw supply and demand or Fibonacci, I have tons of videos on my channel teaching you how to do that already. So I will be leaving those links down in the description. Now, when it comes to the intraday setups, I just trade super basic intraday setups like ABCDs, pullbacks to VWAP or moving averages, bull flags, bear flags, pre-market high, pre-market low breakouts. That pretty much sums up the intraday setups. But again, I would prefer these higher time frame setups. But now here's the one thing that you want to avoid. I'm sure most of you guys who are watching this video want to learn about my strategy. And this is something that I personally did early on in my trading career, and I want to make sure that you guys do not do the same. And that is switching your strategy within 1 to 2 weeks, because I'm going to sit here later and show you trades that I have taken using my strategy, but that doesn't mean that you're going to go into the market and right away the strategy is going to start working, because I can teach you guys the strategy, but you have to go through the trial and error and make some adjustments to the strategy. That way it works for you. So I would say, regardless if you're using my strategy or somebody else's strategy, give it like 2 to 3 months. And if after 2 to 3 months, it still makes no sense and it's not working, then that's when you can start learning a different strategy. And again, I made this mistake a lot early on in my trading career. I would try MACD, it didn't work. I would immediately switch to like RSI, it wouldn't work. I started messing with a bunch of different moving averages, it didn't work. I didn't give myself enough time to fully learn the strategy before I started switching. It wasn't until I started sticking with one single strategy, mastering that strategy, and then adding on to it that I really start to see consistency in my trading. So now here's the thing that profitable traders do that unprofitable traders do not. So if you want to separate yourself from the unprofitable traders, here's what you need to start doing. Profitable traders do not chase profits. They simply let the market come to them and take the setup only if it's there. And they're okay regardless of what the outcome is. Profitable traders stay patient. For example, last week, I did not trade Monday. I did not trade Tuesday. I did not trade Wednesday. I took a small trade on Thursday, but then Friday, I had a massive day and took 3 trades. This week, I didn't trade Monday. I didn't trade Tuesday. But guess what? I took 1 trade today on Wednesday, and it was an absolute banger. And again, we're going to go over that trade later in this video. So staying patient and adopting the mindset that you don't have to trade every day and only trade when an A+ setup is given, that's a mindset that all profitable traders have adapted to, compared to unprofitable traders where they think they have to catch every move in the market, they have to trade every day, and as a result, that leads to over trading, and they end up losing money because of it. Profitable traders use proper risk. Every single time I enter a position, I I already know where my stop loss is going to be and exactly how much I am risking on that trade. Unprofitable traders, however, they don't follow risk management. They get into the position and they know they're supposed to stop out. They don't end up selling because they don't want to take the loss. And what happens 99% of the time? The loss just gets larger and larger and larger. And profitable traders follow a process. Every single day, I know exactly what I am looking for in the market. I have a game plan for the day. I know where I'm going to enter. I know where I'm going to exit. Unprofitable traders, they just go into the market every day and they kind of just wing it. So now that you know how to separate yourself from the unprofitable traders and how to truly be a profitable trader, I do want to talk about stocks to trade. So when it comes to trading, you only want to focus on stocks with liquidity. For example, Apple, Nvidia, SPY, QQQ, etc. The reason why I emphasize SPY and QQQ is because those are my two favorite stocks and they make up probably about like 98 to 99% of my trades. And the reason why we want to focus on these stocks with liquidity is because trading highly liquid names increases the probability of success. If you're trading illiquid names, the spreads are more than likely going to be wide. They can be manipulated, and overall they are a lot harder to trade. If you stick with these highly liquid stocks and you trade them over a long period, you're going to start to become familiar with the price action. And that's why I really emphasize SPY and QQQ, because I've been trading them for so long, I know their personality. And again, I have tons of videos on my channel teaching you guys on how to trade solely SPY and QQQ, so I highly suggest you guys check those out as well. Now, when you're going through these stocks with high liquidity, the main things that you want to do is mark key levels, define your entry points, and create a game plan. So I want to show you guys my game plan for today. Today, I really only like SPY and QQQ, and then I had some side watches on Meta and Tesla. But if we're looking at SPY, we can see that I said I have a reject at 531.35 and then 536.9. Those are the two areas that I am looking for price to come up to. And then from there, I'm going to look for a reject to look for puts. But then I also said calls above 529.75. That way we could ride it up into this reject level or break below the 4-hour bear flag for puts. And then we can see with QQQ, I was looking for a reject from around 449.50 to 450, and then another reject at 455.65. From there, I was looking for calls above 447.07 or puts below the 4-hour bear flag. So again, I had everything laid out this morning. I had my key levels, I knew my entry points, and I had my game plan. And then from there, we trade the game plan. I saw this tweet a while ago and it's very true, so I want to share it with you guys. Your biggest days in the market are going to stem from a solid pre-market game plan. So now let's talk about this strategy and let's look at some trades that I have taken. So again, we talked about how I find my key levels, supply and demand, Fibonacci, support and resistance. Once you have those key levels marked out, the main thing you want to do is watch the price action and watch the volume, because that's going to be the thing to tell us, hey, now is the time to enter the trade, or no, this level is not valid, let's not take the trade. So because most of the time I'm trading my key levels, I'm mainly looking for bounces or rejects. So when price comes down to a bounce level, I am looking for bullish candlestick patterns. A bullish hammer. I don't really look for inverted hammers, but I look for dragonfly dojis and bullish engulfing candles, or just long lower wicks. Now, if price is coming up to a reject, I'm going to be looking for bearish candlesticks. I'm going to be looking for inverse hammers, gravestone dojis, bearish engulfings, or just long upper wicks. So now before we continue, what we have covered so far is my system. Again, I keep it very simple: supply, demand, Fibonacci, support and resistance, why traders are not profitable, and how you can separate yourself from the unprofitable crowd, stocks to trade, and the entry criteria. So now once we have that price action at a key level, from there we want to look at the volume, because the volume is going to be the thing to tell us, hey, there are truly buyers or sellers sitting at your key level. So let's hop into some trades that I have taken in the past using my supply and demand levels, Fibonacci, or support and resistance. So this is a trade I ended up taking based off of a 30-minute demand zone. So we have our small red basing candle right here before a large aggressive move up, leaving unfilled buy orders. So now this area right here is going to become a bounce level, and I want to look for price to trade down into it. I want to look for bullish price action and bullish volume. So now breaking it down to a 2-minute time frame, typically I'll snipe my entries either off a 5-minute or a 2-minute. You can see that the market opened right here at 9:30. We traded up into this high point, but then from there we flushed down into the demand. What happened as soon as price hit that demand level? We got this very long lower wick, a huge elevation in volume, and price shot right back up. So for this trade, I ended up starting my position right here, and I ended up adding to my position as we dipped back down towards this demand level. And then from there, I was able to capture this move all the way back up into the daily highs. But again, this was the candle that said, get into this trade. If it was a very small green candle with very light volume, that would not tell me to get into the trade, and I would have avoided this position until I saw a candle like this, or later in the day, a candle like this. Here's another trade that I took based off of a demand zone. So this is QQQ on the 4-hour time frame, small red basing candle, large aggressive move up, leaving unfilled buy orders. The demand level was from 479.82 down to 478.14. So the next time that price trades down into this level, we want to look for bullish price action and bullish volume to get long. So now later in the day, when price traded down into that level on the 5-minute time frame, we have a very small red candle, this lower wick right here giving us a hammer, but a huge elevation in volume. So again, we are trading right at my key level of demand. Elevation in volume with a nice lower wick is telling me that buy orders are getting filled at this demand, and that confirms a long entry with a stop loss right below this low. I also want to look at the trade that I ended up taking today. So again, if we go back to my pre-market plan from today, SPY, reject 551.35. And as you can see, 551.35 is right here. So we end up going into my level, 551.35. We started to break above it, ultimately failed, and I actually ended up entering like halfway through this candle because we started getting an inverse hammer and I saw the volume coming in, and my stop loss was right above this high right here. Now for me personally, I caught this nice move down into this level right here before stopping out the rest at break even on this pop back up. But again, this is exactly what I am looking for. I'm finding higher time frame levels. Again, this came from the 4-hour time frame, just a basic Fibonacci retracement, pivot high to pivot low. So I'm using higher time frame levels. I'm waiting for price to trade into that level. In this scenario, because it was a reject, I'm looking for bearish candles and bearish volume. If I was looking for a bounce, I'm looking for bullish candles and bullish volume. And if we get that, I will take the trade and I will put my stop loss on the opposite side of the entry candle. So those are just a few examples of trades that I've taken using this strategy. So now here are a few tips for consistency, because I gave you guys a strategy. I showed you how you can apply it in your trading and find winning trades using it, but now you need to focus on the consistency. Number one, you need to always have a defined stop loss before your entry. Again, typically I will place my stop loss right on the opposite side of the entry candle. At max, you only want to take 1 to 2 trades a day. Don't be that person that's taking 4, 5, 6, 7 trades a day. You're going to lose your profits, you're going to overtrade, and you're more than likely going to give money back to the market. You need to be looking for a bare minimum of a 1-to-1 risk to reward, meaning if you are risking $30 on the trade, you need to be looking to make at least $30. And again, that is bare minimum, because if you're risking 30, but you're taking profits at 15, that's not sustainable over the long term. Those losses are going to wipe out your profits plus more. So at a bare minimum, you need to be looking for a 1-to-1 risk to reward. Ideally, you want to be looking for a 2-to-1. Number 4, you need to be comfortable with not trading every day. And again, I talked about that earlier in this video. Last week, Monday, Tuesday, Wednesday, took no trades. This week, Monday, Tuesday, no trades, because the market did not offer me an A+ setup. So once I adopted the mindset that I don't have to trade every day and to just wait for when the market tells me to get in, I became a lot less stressed in my trading. I become a lot more consistent, and I've made a lot more money. And number 5, arguably the most important, is you need to start journaling. And why is journaling so important? Journaling is important because you're going to 1, identify what you're doing wrong in the market. 2, you're going to identify what you're doing right. And 3, you're going to be able to know your ideal market conditions. So if you journal every single day for the next 6 months, you're going to be able to go back and see, wow, I've been doing X, Y, and Z wrong. And most of the time it leads to a red day in the market or a significantly large loss. But then also you're able to identify, wow, well, when I have my biggest days in the market, I'm doing X, Y, and Z right. I should probably trade more like this and less like this. But also it helps you identify your ideal market conditions. So using me, for example, I don't like when the markets are too volatile. It moves way too quick. It's not my ideal market to trade in. But I also don't like when the market is super slow, because then I typically get chopped up in the market and it leads to losing trades. So for me, I found there is a very nice middle ground between too volatile and too slow. And that is typically when I'll look to trade the most and use the largest size. And here are some examples of member success who have been sticking to a strategy using proper size, proper risk, and sticking to A+ setups only. My man BP Loser, I'm still holding this swing trade I saw on a video This is my 4th solo swing that is at least plus 1K. Thank you, Brandon Trades, for going live every morning and for writing those books. Truly worth every dollar. If you guys want to check out the books, link down in the description. Big Mac, no need to be emotional. I'm a professional now thanks to you guys. Look at all that profits. And then the Real Chad 99, best day since starting Mastermind 7 in December. I've grown my account over 400% this year. So this is truly what you can achieve if you start following a system, using proper risk to reward, and taking A+ setups only. But that is going to wrap up this video. So as always, if you guys did find value, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. Everybody have an amazing rest of your day, and I'll see you guys in the next video.